Hello everyone. In this video, I'll discuss about shareholders and investment ratios. Now, this ratio is very important for the person who wants to invest into any business. Because of this ratio, they'll be able to decide is it a worthwhile option to invest your money or not. So I'll start with the first formula, that is dividend yield. And the formula is dividend per share divided by current share price. Why current share price? Because the prices of the share fluctuate with the passage of time. So you might gain by increasing prices, or you might lose because of fall in prices. So that's why when we have to calculate this ratio, we have to make sure that we are considering the current share price which is prevailing in the market. Secondly, dividend per share. We will have the amount which business keeps for the dividends to be paid to the shareholders. So we have to divide that with the number of years. In this way, we will get dividend per share. So the values I have taken, that is 0.15 divided by 1.5 multiplied by 100, the answer is 10%. Now, how you would decide that is it a good percentage or not? For instance, if this improves from 10% to 12%, what you have to consider? Now let's talk about how you interpret this value if it improves, and that will be used for your analysis and evaluation of this ratio, and that is the most important part of such questions, that when you people have to recommend that is it a good option for the shareholders or not. First of all, what you have to consider, has it improved due to decreased share prices? There might be a reason that dividend yield improves because there is a fall in the share prices. So if this falls, then definitely result will be better as compared to the previous year. So this decrease in share price is another not a good sign for the shareholders. They need to see this, that why share prices have decreased. Is there any rumor, bad news about the business, because of that this share price has reduced? So they need to consider this also. Then, has it improved due to the increased dividends? Sometimes it happens that the management of the company decides to pay more dividends to the shareholders to make them happy. So maybe that's why it shows better results. So you have to comment on this also. Then most importantly, whenever you see dividend yield of any one business, maybe you have already invested money into that business, you need to compare that with other businesses, what they are offering, or maybe with the interest rate which is being given by the banks on the savings. Maybe that is a better option for you. Another point which shareholders must consider, that has this ratio decreased due to more reinvestment? Sometimes it happens that the management keeps more profit with the business as retained profit, and they distribute less to the shareholders because they have some bigger future plans for the business to invest into. So then it is not a bad option to invest into, because in the long run you will get more returns. And lastly, what are the trends of change in share prices? If share prices are fluctuating too much, and especially if they are decreasing a lot, it means you are losing on your invested capital as well. Then it is not a good option to be considered for the shareholders. So this is how you interpret this specific ratio. I have discussed quite in detail, so it will be very helpful for you people to analyze and evaluate this. Second ratio we have is dividend cover ratio. Formula is profit for the year divided by annual dividends. So this ratio actually tells us that how many times ordinary shareholders can be paid out, which means if it's a high ratio, it means you are conveniently getting your dividends even if the business is not doing well. Secondly, sometimes we have lower dividend yield, but that is an indication that business has kept more profit as retained profit to be invested into the future investment plans, which is a good sign for the shareholders because they'll earn in the future. Third and the last one is price earnings ratio, which shareholders or the potential investors should consider before investing into any business. Formula is current share price divided by earning per share. And earning per share is profit for the year, the whole profit which business gains, divided by annual dividends, and then you get earning per share. Per share, what's the earning shareholders make? And this current share price, as I have already discussed in the previous formula, that you have to take what is the prevailing market share price, and that you have to consider to use this formula. Now the answer, if it comes out $20. What is the interpretation of this and what you have to consider? First of all, it tells us that how much shareholders are willing to pay for $1 current earning, which means that how much money they are willing to pay. So if it goes up, it means shareholders are confident about the business and they are willing to pay high price to get $1 of earning from that business. So that is a good sign for the business that their policies are good and people have confidence. Secondly, which companies can have high price earning ratio? Now the companies, those are linked with the technological advancements. There are more chances of getting earnings and people would be willing to pay more price to get $1 of earning. On the other hand, companies like utility companies, they would have less price earning ratio. People would know that returns would be very slow and very less, so they would not be willing much to invest high amount in those shares. So this is how you people have to do interpretation when you calculate this price earning ratio. That's all for shareholders and investment ratios. Thank you for watching the video. Happy learning.